So let's get started on becoming a more informed and tax-efficient investor.
Managing investments for tax efficiency is an important aspect of growing a portfolio. Gains from investments are subject to taxes just like any other form of income. However, taxes erode returns and consequently reduce a portfolio's growth. Being tax efficient with your investments allows more money to be reinvested back into a portfolio and lets it grow over time. There are generally two categories of taxes on investments: short-term capital gains and long-term capital gains. Short-term capital gains are typically taxed at higher rates like ordinary income. Examples include interest income and realized gains on investments purchased and sold in under 1 year. Long-term capital gains, on the other hand, are usually taxed at a lower rate. Examples include qualified dividend income and realized gains on investments held over 1 year. Because tax rates differ, short-term capital gains are generally tax inefficient, while long-term capital gains are relatively tax efficient. Examples of tax inefficient investments include junk bonds, preferred stocks, and other interest-bearing investments such as money market accounts. These investments are considered tax inefficient because most, if not all, gains are typically received as ordinary income. Because the gains are treated like ordinary income, they can be taxed at higher rates than long-term capital gains. Conversely, examples of tax-efficient investments include convertible bonds and common stocks. Gains from tax-efficient investments tend to come more from price appreciation and less from income. Because gains from tax-efficient investments can be long-term capital gains, they're possibly subject to lower tax rates. One way to reduce the tax burden is to hold tax-inefficient investments within a tax-deferred account. Tax-deferred accounts include 401ks, 403bs, and individual retirement accounts, also known as IRAs. These accounts defer taxes on gains until after retirement. This means gains from tax-inefficient investments can be taxed less if kept in a tax-deferred account until after the legal age of retirement. Tax-deferred retirement accounts can help manage tax-inefficient gains, but investors can manage tax-efficient investments in taxable accounts. Because gains from tax-efficient investments, such as convertible bonds and common stocks, are generally taxed at lower rates, some investors hold these investments in a taxable account. Investors may want to consider trying to hold investments in a taxable account for over a year to classify gains as long-term capital gains and benefit from relatively lower taxes. Managing for tax efficiency in these ways can contribute to greater growth in a portfolio over time. To better understand how taxes impact the growth of a portfolio, let's look at two portfolios that manage taxes differently. Suppose that two taxable portfolios start with a balance of $100,000 and grow 7% every year for 30 years. After paying taxes, gains are reinvested in each portfolio. The first portfolio holds tax-inefficient investments such as junk bonds and money market accounts. Let's suppose gains on these investments are taxed at 28% every year before reinvestment. After 30 years, the portfolio would grow to $437,161. Now, let's contrast that portfolio against another with a lower tax rate. The second portfolio holds tax-efficient investments such as convertible bonds and common stocks. Let's suppose gains on these investments are taxed at 15% before being reinvested. The tax-efficient portfolio would grow to $566,277. In this example, managing for tax efficiency would have resulted in a difference of about $129,000. As the example demonstrates, taxes can have a big impact on a portfolio's growth over time. To reduce the tax burden, an investor may want to consider holding tax-inefficient investments such as junk bonds and preferred stocks in a tax-deferred account. Additionally, hold tax-efficient investments such as common stocks in a taxable account so gains can be reinvested. But keep in mind that taxes are a complex issue, and no two situations are the same. Be sure to speak with your accountant or tax advisor before making investing decisions based on taxes.